Welcome to Informed Investor. Yesterday, there was a screenshot making rounds on social media claiming India's GDP has crossed the 4 trillion mark. The milestone was hailed by many public figures and reported by many news publications too. But unfortunately, India's GDP isn't yet $4 trillion. The official figures tell us a different story. As of June, we're at about $3.38 trillion, not quite hitting that $4 trillion mark just yet. According to the latest budget estimates for fiscal year 24, which is the year between April 2023 to March 2024, India's nominal GDP is projected to be around 301 lakh crore, which translates to a roughly $3.6 trillion economy at the current exchange rate. We see India has not reached a gross domestic product of $4 trillion just yet, but one needs to look at the bigger picture. India is one of the fastest growing economies globally, and it's just a matter of time before we hit the $4 trillion or $5 trillion milestone. The IMF's World Economic Outlook report predicts a 6.3% growth for India in the current fiscal year. Even other projections from rating agencies hover between 6% to 6.5% for the fiscal year 23-24. While these numbers might not be mind-blowing, they do showcase India's resilience amidst global challenges. With these growth rates, India still maintains its status as the fastest growing major economy in the world. Foreign portfolio investors have returned to Indian equities after a selling streak, injecting a significant amount of 1,433 crore in the month of November so far. After turning net sellers in the first 2 months of the calendar year, FPIs pumped a significant amount of money for 6 consecutive months with the tune of 1.74 lakh crore. However, the month of September and October saw them turn net sellers again on the back of increased yields on the US Treasury bonds, the impact of higher crude oil prices, the Israel-Hamas conflict intensifying, and uncertain trajectory of US interest rates. Fast forward to now, FPIs have turned net buyers in November after selling in the first 2 weeks of November. Interestingly, even the debt market attracted an impressive 12,330 crore of inflows into Indian bond markets. The renewed interest from FPIs is a positive sign for the Indian stock market, which has been under pressure in recent months. However, do know that FPI are hot money, fleeing at the first signs of trouble. But the turnaround in current FPI sentiment is attributed to a number of factors, including the decline in US Treasury bonds, the fall in crude oil prices, and more importantly, the ongoing festive season in India. Having said that, this is me, Rahul, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.